Hey, good morning, everybody. It is Pete. Welcome to today's episode of Stocks for Breakfast. Today is Tuesday, March 10th, 2020. Futures are showing a gigantic bounce, which is ironic. I was actually telling somebody yesterday at lunch who's a very inexperienced trader that when we do bounce, you're not going to be able to get in because it will be so severe. And we kind of got it literally overnight. There's one piece of news that people are saying why it's happening. But what we're going to talk about today is why you should not be looking to buy this higher opening today. There's a specific reason for it from a reward potential parameter in exchange for taking the risk. So today we're going to talk about different levels of opportunity and when you should be looking to get involved, because there's a big question between should I be a buyer and should I be a buyer now? They are massively different questions to answer, completely different scenarios. And I believe it's one of the two reasons that most smart traders who work really hard don't get paid is because they can't answer the question whether or not there's enough opportunity to justify the risk that you have to take. And the other one, which I've mentioned quite a few times, is you should minimize the bad trades that you make, which will ultimately immediately make you a more profitable trader. It's really those trades that you shouldn't take in the first place that are the reason most good, smart traders don't get paid. Actually, no, I'm going to take that back. If you're a good trader, you're not making them in the first place, and you are getting paid. Smart traders who are on the bubble, who always feel close that aren't getting paid, should stay away from those trades, and they will, like that, see a bump in their P&L. So what we're going to do is we're going to do two things. We're going to take a look at the headline about today's pre-market. Then we're going to go to some charts. I'm going to discuss why you should not be buying today's opening, what you should be doing instead. And then I'm going to go to a few charts to see what was strong prior to the sell-off happening. We're going to use some simple moving averages and some trend lines, and then we're going to take it from there. So if you find the video helpful, one thing I'd like to ask, if you have any questions, absolutely drop a comment below the video. I will get back to you as soon as I can. And if you like it, also subscribe. So we're going to share the screen now, and we're going to head over to see the news. First, we'll start with the news. Depending on what channel you're watching, they are talking about either an 800 to a 1,100 point bounce in the Dow this morning. I like the headline, Trump floats cut. That doesn't mean it happened yet, so don't translate that into it's definitely happening and how it's going to relate. But the bounce is really the most important thing. And putting the bounce in perspective, this is actually where we are. This is yesterday's close. So you can see we actually traded a little bit lower yesterday afternoon, and the market's kind of getting a relief rally. And I will post the link to the video, but there is a super big difference between a short covering rally and new buying. New buying usually is quiet. In this particular case, as prices are going down and people are shorting the market, short selling means that you're dumping supply, dumping supply, dumping supply. And in order to get out of those short positions, you have to buy it back. And generally speaking, that creates a faster move higher, because what happens is people that are short selling have to get out of the position. They have to get out of the position fast once you start to see some buying happening. And you actually now have new buyers coming into the market who are seeing the prices not going down anymore. As a matter of fact, if you actually start to see them become well bid, you now have higher highs and higher lows on whatever time frame you're watching. Now you're saying, oh my gosh, could this be a bottom? Do I want to be an early entrant into what could potentially be the bottom here? And again, I said early entrant means you use the right share size, which is you don't bottom fish, you work orders, which is the right way to do it. And then ultimately, it has a very fast move. And we discussed this, I believe it was about a week ago. We'll take a look at the daily charts really quick. And I got some really nice questions about short covering versus new buying. And this is a short covering rally. So the reason I'm saying not to jump in as soon as the market opens today is because you can see we're up, let's say, 2,700 to 2,880. That is a monster move. That's a monster move. So we have to let that move settle in first after the market opens. In the regular market, if I go to the SPY, you're going to see, we'll see a giant gap between where it closed yesterday and where it's going to potentially open today, which is up around this area. So we're actually going to open up with a gap outside of yesterday's trading range, which, by the way, mistakenly heard some traders in the past call a gap that opened up inside of yesterday's price action a gap. That's not the true definition of a gap. A gap is when it opens outside of the previous day's trading range. If it's inside yesterday's range, it's simply a higher or lower opening. A true gap is actually outside. So it's kind of important to make sure that you have the terminology correctly there. So we're going to actually have that higher move open. So the point is, we're going to open up, assume it's early now, it's only 6:48. We're going to open up around in this area here. The best spot to be looking, if you're looking to initiate a new trade, is here. We want to use yesterday's high as a level of support. This is where something significant happened prior to what appears to be today's move open. So in any of the stocks that we're looking at, that will be the, I'm not going to say the safest because that's not the right terminology and I don't want to imply safety. That would be the appropriate spot to look to bid because you've had the gap higher, you've given it room to prove whether or not it's just a short selling rally and the market is going to sell off again, or if it's a new buying after the short covering rally, we'll get some relief pulling back. We'll end up holding because new buyers came into the market, and then that support comes in. So this is the most likely place in the market that buyers will come back in, just around 284-ish in that area, 283.50, 284. So you have a choice now. You could exclusively trade your stock, and we'll take a look at some stocks using this same chart to see where some support levels are. Or you could wait for the market to bottom out and only then look to your stocks to see, should I be getting long? Now, the proper way to do it, for lack of a better way of putting it, is to get more proof in the market. And what's interesting is I'm also asked very frequently why I focus so much on the SPY, and it really comes down to math. 500 stocks in the SPY versus 30 stocks in the Dow. I think it's a better barometer of the overall buying and selling pressure. That's my opinion. That's not, I'm not saying you have to do that, but to me that just makes sense. So I always watch the SPY. Today I'll be watching for the SPY to pull back. Now the key here is, and actually this is something that was also asked yesterday in the lunch I had. What is my main goal for doing these videos? And it really comes down to is I hope that I'm preparing you to know exactly what you're going to do when the market opens, and especially helping you think through what you're going to do before you need to make that decision. And if you're struggling right now as a trader, it might be hard to really wrap your head around, but the trading part of what we do is actually simple if you're prepared going into the market. And it really comes down to this. If you have your game plan, and I've discussed this in the past, I do my game plan 7 p.m. or 7 a.m., preferably both actually, where you do the game plan, you kind of let it sit overnight, and at 7 o'clock the next morning, you look to see if anything changes. Did anything change to your plan? Excuse me, did news come out on your stock that might affect how you might enter the stocks? Once you have what you expect to happen, and what's interesting also is we just literally mapped out the first half hour to 45 minutes of the day. So when you take that into consideration, there's really no frenetic, what do I do when the market opens? You're literally sitting back saying, all right, I know exactly what I need to see. And if that happens, I know what I'm going to do. If it doesn't happen, I'm not going to force trades. Is that an oversimplification of how easy, I'm not, again, I don't want to say easy, how less stressful trading can be? No, it's not. That's actually what trading's supposed to be. It's when you combine being prepared and literally taking it to the next level where you actually map out, what's supposed to happen on the open. After the market opens, it really comes down to you should only be looking to do what you see. So when you take that into consideration, it's not really that difficult to run a trading business that's not just full of monster stress. So I hope that point that I just made doesn't go past like you're like, yeah, whatever. That was so important. I really recommend that you listen to that again and then compare what I just said about being prepared and how easier the market should be after it opens and throughout the day compared to what you might be doing now, or maybe you're running a ton of scans or you're watching the news, and that kind of stuff. Give it a try, and I'm pretty confident you'll see that it's the right way to trade. All right, so we're going to go through some stocks, and what I want to do is I'm going to go back out to the daily charts, and I'm going to put in a 20-period moving average just to look at this window of opportunity over here prior to the sell-off. So I want to look at stocks that were above the 20-period moving average, which is obviously the shorter-term period moving average that showed significant strength prior to the sell-off. And those would be the stocks that we'd be looking for opportunities. Actually, interestingly, Apple was getting a super amount of positive news, and you can see we were actually above the 20, but we kind of went sideways for the year. And ironically, I just read an article about how great Apple looked prior to the coronavirus hitting, but you can see it actually for all of 2020, even prior to this, it really didn't move. So I'm not really sure what that person was talking about. That was actually a run up prior to 2020, which is literally right on the dot, right? So Apple definitely one of the stocks to take a look at. Might not necessarily have been the strongest where it was actually rallying up into that point, but definitely one to consider. Now, what would you be considering? Again, I want to make it clear. If you go down to the 15-minute chart on whatever time you're looking for yesterday's high to be support. So again, something like Apple, we'd be looking at this level here. And I'm sure if you're an experienced trader now, you noticed I'm not drawing my support and resistance lines at the high or the low. I'm actually drawing it. I'm not putting it up here. I'm putting it here. I'm actually looking for where price action stopped or started with the candlestick itself. And that's kind of what I'm doing here. I think it's just lazy, just saying the high is where I think it's going to stop. And think about it from a perspective of price action and volume. Imagine 100 shares traded at the high, and you give all of this importance to that's the high, that's where I think it's going to be, when only 100 shares traded there. We've discussed this in the past in a book called Tape Reading and Market Tactics by Humphrey B. Neal. It was written, I think, in the 1937, I think. Way back then. You can get it on Amazon for like $8. I highly recommend picking it up if you happen to have a weekend or you want to read a fascinating book from back in the day. It talks about where the entire market's volume was 500,000 shares for the day. But he does a super good job of discussing, imagine that stocks are like jackets at a store and you're looking at the line of seeing how many jackets sold versus what price they sold. And if you think about it, that's kind of really deep and eye-opening. If you're just looking at the line and you're saying, well, we sold jackets at $20, but there was one jacket sold at $20. And you're like, yeah, we're selling jackets at $20 versus you sold 300 jackets at $19.50. It's really $19.50 that you're looking for as the significant price, not the $20. So it's something to keep an eye on when you're actually going through your prices and looking for the actual support and resistance. And if you think about it, you can actually save money by risking the proper amount by finding the right support or resistance. And you can actually drill down even a little bit deeper on the intraday charts to see where the most volume actually traded at certain levels. But that's actually a whole separate video. We don't necessarily need to do that right now. So Amgen, basically the same thing, and you can kind of get a feel. Amgen's actually opening lower. What I didn't notice there was Apple actually opening $2.83 higher at 269. Let me get that volume off the screen. Sorry about that. So it's not opening with quite as much fervor as the SPY was showing before, the SPY futures specifically. So now you actually have a different scenario. You're going to most likely end up bouncing here, probably pulling back similar to what we were saying before, but now you're not going to buy while it's in the middle of yesterday. So you want to get past yesterday's price action. So you'd be looking for the first close outside of this range. If you're looking to initiate a new swing trade, let's say that you want to put on a position and you're like, my gosh, Apple has pulled back that far. Yeah, that's the price. The price is where everybody else in the universe sets their buy stop or sell stop outside of yesterday's trading range. If you want to be a little bit more aggressive, you would look for the opening price window, which, as we've been discussing, is the opening 15-minute range. It's a much tighter stop loss, but again, you're initiating it inside of yesterday's price action, which means we'd be a buy stop outside of the high of today's 15-minute window, and today's opening low would end up being, low, not opening low. Today's low would be the stop loss. You'd have a much more likely tighter stop loss where you can manage risk a little better on a potential new swing trade long if you want to participate in the bounce. So that is really the opportunities for today. I don't necessarily want to get into, because we actually just covered two of them. We covered what to do if you gap up higher than yesterday's high, waiting for that pullback in what should be a significant reference point to bid. In that spot, you'd either be looking for a bullish U-turn, you'd be looking for a push down into that, and an inside candle looking to trade the inside candle higher, or a swing low. And if you're not sure what a swing low is basically a low with two higher lows on each side. So you kind of have confirmation that it pushed lower, got a higher low, and looking for a move back in the other direction. If we open up inside of your favorite stock, you have two choices. You wait for today's high to be taken out, yesterday's high to be taken out and get above there to initiate a trade. If you want to trade a little bit more aggressively, you look to those intraday timeframes if you happen to be sitting at your screen, and you'd be looking for the opening range breakout. And those are really the setups for today. If today's bidding holds, hopefully it does. And here's the key. I just said hopefully it does. If you want to move from chart reader to trader, which is my biggest goal for you, which is the difference between just looking at the charts and setting up trades versus actually understanding how to take money from the market. If the bids don't hold, if the market doesn't support new buying after this short covering rally, then you have to be disciplined and you have to program that stop loss in there. And you have to say to yourself, okay, I put my trade in. There was a probability it was going to bounce if the short covering rally held. I put the trade on, and either it holds or it doesn't. And this kind of gets back to what I was saying before. I'm actually going to come off the share here. So if it bounces and holds, and you say to yourself, okay, it held, I know exactly what I'm going to do, fine. Now you have to say to yourself, what's the next step? And we're prepping this way before the market opens. It's 2.5 hours before the market opens, right? If it holds, do you plan to add to that position, and what does that need to look like? Now, we've had some really, really severe moves. You have to decide if you add to that position. Let's just say, for argument's sake, you put a good trade on, it bounces, moves in your favor, now you have a nice winning trade. What are the odds of that holding, where if you add more to that position at a particular price, what are the odds of now bouncing from here to all the way up here? And let's say we have another $2,000 point bounce in the Dow. We recover everything from yesterday. What are the odds of that holding there and just continuing higher versus now you have your first entry here and your second entry all the way up here? Does this second entry, after bouncing an abnormally large 2,000, pull back and now you end up at break even on the two positions? So you really have to decide right now, what do you believe is the probability of today's bounce continuing and rallying where you can end up having a profitable position? The answer to coronavirus has not been solved overnight, I can tell you that. Could you be trading a 1 or 2 day swing trade if you get a head start? Sure, absolutely. Just make sure you're managing your risk. Do you add to that position? Completely up to you based on what you believe to be the probability of those stocks following through. I don't know your risk tolerance, so I can't say specifically, but my job, again, and your job as a trader, if this happens, then I'm doing this. If this happens, then I'm doing this. And that's all based on, do I want to be long or short? Do I want to be long or short now? And if you are, what are the odds of following through? So the big thing that we can't ignore right now, let me actually reword that in the positive. The big thing we have to pay attention to right now is the fact that we've already gone this monster difference from where it bottomed out yesterday to today. So that's why I'm expecting a little bit of a pullback off the short covering rally. That's going to expand and give us a little room to breathe with a new entry. But if we rally again off of that, what are the odds of that following through, that if you wanted to put a second position on, that second position would be profitable? Obviously, the ultimate news would be a cure, which we're not seeing that right now, hopefully soon. So you have to make a decision. Do you want to accept a little bit more exposure in exchange for a little bit more profit, or do you want to initiate that initial trade and let that run? So that's completely up to you. Again, I don't personally know everybody, and I can't tell you exactly what to do. But if we're doing our job together, that means we're interacting. So please leave any questions you have below the video. I'll be more than happy to get back to you as soon as I can. And if you find these videos helpful, absolutely, please subscribe. So it is Tuesday morning, March 10th, 2020. Stocks for breakfast. I'm Pete Renzulli signing off. Have an awesome day and have a profitable day. Take care, everyone.